Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Health and Happiness H&H International Holdings Limited Annual Report. Health and Happiness H&H International Holdings Limited offers a diverse range of products and services across various categories. The company's product portfolio includes pediatric nutrition, baby care, adult nutrition and care, and pet nutrition and care products. In the infant and child segment, H&H provides milk formulas for infants, children, and expectant and nursing mothers, as well as probiotic and nutrition supplements in sachets, capsules, gummies, and tablets. The company also offers dried baby food and baby care products. For adults, H&H manufactures vitamins, herbal and mineral supplements, skin care, and sports nutrition products. In addition to these products, the company is involved in the research, development, manufacture, sale, and processing of various nutritional foods and products. The company's services include marketing and distribution of organic baby food, wholesale, retail, import, and export of nutritional food and personal care products for infants, and provision of packaging services. H&H also engages in trading and sales of vitamins, health supplements, skincare, and sports nutrition products for adults, as well as pet food and nutritional supplements for pets. Furthermore, the company provides online sale and software and information technology services. Its products are sold under various brand names, including Healthy Times, Biostime Changsha, Farmland, Swiss, Orlia, Zesty Paws, Solid Gold, Dodie, and Good Gout. Health and Happiness H&H International Holdings Limited maintains a market capitalization of $8 billion, broadly in line with the industry peer group. Health and Happiness H&H International Holdings Limited trades at a higher price-to-earnings ratio of 35 times, and a higher price-to-book ratio of 1.14 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 69% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.88%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for the company can be attributed to several key factors. Firstly, the nutritional supplements segment experienced significant growth, with a 29.4% increase in 2025 compared to 2024. Additionally, the adult nutrition and care products segment saw a notable rise, with a 36.6% growth rate. The Chinese mainland market also contributed to revenue growth, with an 11% increase in 2024, followed by a 15.4% growth in 2025. The company's strategic initiatives, such as the mega brand strategy and the premiumization of Solid Gold in the Chinese mainland, have also driven incremental growth. Furthermore, the strong performance of early-stage formulas with retail scan sales growth of 37.7% and 37.9% has been a significant contributor to revenue growth. In terms of specific product categories, Swiss's outperformance in innovative areas such as heart health, anti-aging, and detox has driven growth. The company's focus on premiumization and reallocation of resources toward higher-margin pet food and supplements have also contributed to revenue growth. On the other hand, the primary drivers of revenue decline are limited. However, it is worth noting that the adult nutrition segment declined by 13,754 RMB in Australia and New Zealand. Additionally, the impairment of goodwill resulted in a minus 100% change from 2024 to 2025. The net income of the company underwent a significant transformation between 2 consecutive years. Initially, it experienced a substantial increase of 465.2% from a loss of RMB 53.7 million to a profit of RMB 196.1 million. However, this growth was short-lived, as the net income decreased by 12% in the subsequent year. The company's profit margins also witnessed some fluctuations. The adjusted net profit margin saw an increase of 0.5 percentage points from 4.1% to 4.6%. On the other hand, the adjusted EBITDA margin experienced a decline from 15% in 2024 to 14.3% in 2025. A closer examination of the gross profit margins reveals that they increased overall from 60.6% to 62.4%. This improvement was largely driven by the ANC and PNC segments, which saw their gross profit margins rise due to optimized sourcing costs, favorable changes in channel mix, and product mix. In contrast, the BNC segment witnessed a decline in its gross profit margin due to an unfavorable shift in product mix. The reasons behind these changes are multifaceted. The company's ability to optimize sourcing costs, adjust its product mix, and capitalize on favorable market trends contributed to the improvement in gross profit margins. However, the decline in the BNC segment's gross profit margin serves as a reminder of the importance of maintaining a balanced product portfolio and adapting to changing market conditions. The company's financial performance indicates a strong ability to generate operating cash flow. This is evident from various points in the summary, including the reduction of net leverage ratio due to strong operating cash flow, page 7. Furthermore, the company was able to reduce its total gross debt by over RMB 600 million during the year, which is also attributed to strong operating cash flow, page 10. The most direct confirmation of positive operating cash flow comes from page 21 and page 92, where it is stated that the company generated a positive operating cash flow of RMB 1,536.8 million for the year ended 31 December 2025. This is also reflected in the net cash flows from operating activities, which is reported as RMB 1,536,810, page 92. Overall, these points suggest that the company is generating a significant amount of positive operating cash flow, indicating a healthy financial position. The financial documents reveal a mixed performance across various segments and regions. On the positive side, nutritional supplements, adult nutrition and care products, Chinese mainland, North America, infant formulas, baby nutrition and care products, pet nutrition and care, pediatric probiotic and kids nutritional supplements segment, adult nutrition, and pet and kids nutrition all showed strong results. However, some segments and regions underperformed. Specifically, the poorly performing segments include infant formulas and baby nutrition and care products, which is a contradictory result as these two categories were also listed among the well-performing ones. Additionally, Australia and New Zealand, ANZ, and other territories struggled to meet expectations. Management is optimistic about the company's future prospects. According to their statements, the company is expected to experience sustained growth in 2026 due to the success of marketing campaigns and product expansion. This growth will be driven by a strategic move into the children's nutrition category beyond the infancy stage, indicating an ambitious expansion plan. In terms of financial projections, management has estimated variable consideration based on historical data, business forecasts, and current economic conditions. While this does not explicitly outline their strategy, it suggests that they are taking a cautious yet informed approach to financial planning. Overall, management's outlook is one of growth and strategic expansion, with a focus on leveraging marketing efforts and product diversification to drive success. The company's financial performance indicates a commitment to shareholder value creation through various means. One notable aspect of this commitment is the payment of dividends. According to the provided information, the company has indeed paid dividends. On page 7 of the report, it is explicitly stated that dividends paid, yes, confirming the company's decision to distribute a portion of its profits to shareholders in the form of dividends. This demonstrates a focus on rewarding investors for their loyalty and trust in the company. The company's financial reports highlight several concerns regarding its inventory management and supply chain. One of the primary issues is the buildup of obsolete and slow-moving inventories, which has resulted in a significant provision for impairment on page 83. This is further supported by the carrying amount and allowance mentioned on page 132. Moreover, The company's reliance on sourcing raw materials from various regions makes it vulnerable to geopolitical tensions, shipping delays, and increased transportation costs, page 57. These external factors can disrupt the supply chain, leading to potential inventory shortages or overstocking. The changes in inventory levels reported on page 161 also raise concerns about the company's ability to manage its stock effectively. The increase in raw materials, plus 41% from last year, and goods in transit, plus 389% from last year, suggests a potential buildup of inventory, while the decrease in finished goods, minus 6% from last year, indicates that the company may be struggling to meet demand. These trends suggest that the company needs to reassess its inventory management strategies to mitigate these risks and ensure a smooth supply chain operation. That concludes the financial summary for Health and Happiness, H&H International Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.